Well, I think the market is still trying to figure out whether second quarter earnings are going to come in better than expected, as most of them did last week. Also, we're being encouraged by additional coronavirus tests coming from the UK that have been positive. So the absence of any real negative news, I think, is allowing stocks to continue to drift higher. Well, with interest rates as low as they are, below 1% in the 10-year note, history basically says you're better off sticking with the growth stocks. Value stocks tend to outperform when interest rates start to rise, and that's usually when there is an expected surge in economic growth. But right now, I think investors are sticking with the trend, and the trend remains your friend with growth. Well, it's very different this year than last year. However, the National Retail Federation thinks that we're going to post record results. They are forecasting $790 per family for high school, middle school, elementary school spending this year. College expenditures are expected to be about $1,060 per family, and that we are going to see more than $100 billion in overall back-to-school spending, which is the first time above the $100 million mark. So they are being obviously optimistic. In many ways, you might think that they have to be. We are a little more cautious. We do favor many of the companies that would benefit from a virtual education environment, meaning that if you are going to have to buy laptops and computers in order to go to school from home, then companies like Amazon, like Best Buy, would do well in terms of selling those computers. And then obviously Dell Computer could do relatively well in terms of manufacturing the computers. So in general, our belief is that we're still going to have a lot more students working from home than all of the schools simply opening up once again. Well, the apparel manufacturers might have a challenge because it's very hard to be in a high school fashion show if nobody's in the high school. So there's no runway, if you will, with which to show off your new outfits. So I would tend to think that some of the apparel manufacturers and apparel retailers might have some tough going because the students are going to dress as comfortably as adults do when they are working from home. Well, it seems as if it's more temporary at this point because the coronavirus situation is more of a man-made thing in terms of man shut down the economy and triggered the bear market. But we have been seeing an improvement in relative price performance for the S&P industrials and materials sectors, which usually points favorably to an improvement in economic forecasts. So, maybe we will just have a pretty tough second quarter when that GDP data comes out, but then expectations are for an improvement in the second half of this year and in all of 2021. The second quarter looked ugly to begin with and continues to look pretty bad, with the estimates calling for a more than 45% year-on-year decline in the S&P 500. We are starting to see slight improvements in the third quarter and fourth quarter estimates, but not much movement in terms of 2021. So we're still looking for close to 30% growth in earnings for next year for the S&P 500, 50% for mid-cap stocks. But I think we're going to have to start to see a gradual uplift in forward estimates in order to justify valuations and investor optimism. We saw the bear market of 1990 get back to a new all-time high in only 4 months. The bear market of 1982 getting to a new all-time high in only 3 months. And if you want to stretch that a little further, 1966, we saw a new bull market in only 7 months. So even though on average, sub 40% bear markets take 14 months to get back to break even, following the most recent bear market of 34%, we could end up getting back to a new all-time high before the year is out.